In 1831, in a neighborhood called Frankfort in Philadelphia, a group of 40 tradespeople pooled their wages and lent money to a man named Comely Rich. Rich was a lamplighter and comb maker. He borrowed $375 from his neighbors to buy a house that cost $500. He repaid them monthly. The house he bought at 4276 Orchard Street in Frankfort still stands today. That institution, the Oxford Provident Building Association, was the first savings and loan cooperative in the United States. By 1927, 12,804 of them existed across the country, with 11.3 million members. 1 in 3 institutional home purchases in the United States was financed through mutual cooperatives of this kind. Institutions that charged no upfront fee paid to a third party to protect the lender, held no external shareholder, and extracted no profit from the relationship between borrower and loan. You cannot access federal mortgage insurance today through a mutual cooperative of that structure. The reason has nothing to do with financial safety. By the time this video ends, you will know the name of the organization whose president called the legislation that created the current system the most fundamental legislation ever enacted affecting real estate and home ownership. And you will know the specific financial mechanism paid by every FHA borrower in the United States today that permanently moved the insurance function out of member-owned mutual reserves and into a federally managed fund that protects lenders. The Oxford Provident model worked as follows. 40 members contributed monthly shares into a pooled fund. When the fund reached sufficient capital, a member could bid for a loan to purchase a home. The loan was secured against the property. The borrower repaid into the mutual fund, which then financed the next member's home. There was no external investor. There was no separately extracted insurance fee. The cost of the loan was the cost of administering it. This model spread across the country. The Encyclopedia of Greater Philadelphia records that savings associations of this type had reached all states and territories by 1890. By 1920, 5,869 building and loan associations were operating in the United States. By 1927, their recorded peak, the Federal Reserve Bank of Richmond's 2019 Economic Brief on their history documents, 12,804 associations, 11.3 million members, and $7.2 billion in combined assets. The same Richmond Fed research records that these institutions accounted for approximately 1/3 of the institutional residential mortgage market at their peak in the 1920s. They were the dominant specialist in residential home lending. And then came the Depression. Building and loan associations held their assets almost entirely in residential mortgages. As incomes fell and mortgage delinquencies spread across American cities, institutions concentrated in one category of loan had nothing else to fall back on. Federal Reserve economists, in their analysis of troubled real estate lenders during the 1930s, document that building and loan associations faced the brunt of mortgage delinquencies precisely because they were specialists. Unlike commercial banks with diversified loan portfolios, building and loan associations had concentrated their capital in residential mortgages. When those mortgages failed, the associations failed with them. By 1941, 6,000 building and loan associations had collapsed. That was half of the total that had been operating in 1929. The cooperative model for residential home financing was not simply weakened by the Depression. It was halved. Into that collapse came the National Housing Act of June 27, 1934. Who shaped the organization that act created and what financial mechanism they built into it is the next part of the story. And it involves a FEE paid by every FHA borrower in the country. The National Housing Act of 1934 created the Federal Housing Administration. The Federal Housing Administration, FHA, would insure residential mortgages against default. Lenders that met federal approval criteria could originate FHA-insured loans. If a borrower defaulted, the FHA would compensate the lender from an insurance fund. The insurance fund is filled entirely by borrowers. Every FHA borrower today pays two mortgage insurance premiums. The first is an upfront premium of 1.75% of the loan amount, paid at closing. On a $300,000 mortgage, that is $5,250. The second is an annual premium assessed on the outstanding balance. Following HUD Mortgagee Letter 2023-05, which reduced rates effective March 2024, that annual premium is 50 basis points, 0.5% of the outstanding balance, collected monthly throughout the loan term. For borrowers with less than 10% down, that premium continues for the entire 30-year term. There is no exit from it except refinancing into a different loan type. The Consumer Financial Protection Bureau states this directly. Federal Housing Administration mortgage insurance, usually abbreviated FHA, is not designed to protect the borrower. It is designed to protect the lender against the risk of default. If a borrower defaults and the property enters foreclosure, the Federal Housing Administration reimburses the lender from the insurance fund. The borrower pays. The lender is protected. The Oxford Provident Building and Loan used a structurally different mechanism. The cooperative's accumulated member contributions served the insurance function. When defaults occurred, the cooperative absorbed them from its own pooled capital. No premium was extracted from the borrower's payment and sent to a federal fund for the lender's benefit. The protection cost was embedded in the structure, not added on top of it as a separately extracted fee. The Federal Housing Administration mechanism did not replace the cooperative reserve with something functionally equivalent. It placed a new, mandatory, borrower-funded charge on every insured mortgage, a charge whose sole beneficiary is the lender, and made that charge a permanent feature of the most widely used low-down payment mortgage product in the United States. Who designed that structure and what they did with the organization built around it is the next part of the story. The National Association of Real Estate Boards is the trade body representing residential real estate brokers and mortgage originators in the United States. It was founded in 1908 in Chicago. It is today known as the National Association of Realtors, the largest trade association in the United States, with more than 1.5 million members. Its membership includes every major national brokerage network operating in the American real estate market. When the National Housing Act passed in 1934, NAREB President Hugh Potter issued a public statement calling it the most fundamental legislation ever enacted affecting real estate and home ownership. That statement is part of the documented record. NAREB members worked as advisors to the federal government when the Federal Housing Administration was created. According to the Johnson County Museum's documented history of the Federal Housing Administration and suburbia, NAREB members brought their established industry practices to the table as federal housing policy was being shaped, and those practices were incorporated into the Federal Housing Administration's operational framework. The National Association of Real Estate Boards did not create the mortgage insurance premium, but it was the dominant organized voice for the commercial real estate industry during the Federal Housing Administration's founding. Its members were present as the agency's policies were written, and its president described the resulting legislation as the most significant housing statute ever enacted. The Federal Housing Administration structure that emerged from that process created a permanent, mandatory, borrower-funded insurance mechanism collected on every Federal Housing Administration loan that protects commercial lenders. The building and loan cooperative model, which had distributed the insurance function internally among members, was in the process of losing 6,000 of its institutions to the Depression. It was never rebuilt as the dominant form of residential mortgage lending in the United States. That is not a regulatory accident. That is the business model. The National Housing Act of June 27, 1934, is available in full through the Federal Reserve's Fraser Digital Archive. And here is the part that should really bother you. Walk into a credit union mortgage office today. The credit union is a mutual cooperative. Its members own it. Its surplus, the equivalent of profit in a commercial institution, is returned to members as reduced rates or lower fees. There is no external shareholder extracting margin from the mortgage transaction. The National Credit Union Administration publishes quarterly rate comparisons between credit unions and banks. In the second quarter of 2023, that data shows credit unions offered 30-year fixed-rate mortgages at 6.72% against a bank average of 6.76%. That differential is modest measured in a single month. Over 30 years, on a $300,000 loan, a sustained rate advantage of 4 basis points is thousands of dollars the commercial lender does not take. Federal credit unions are permitted to originate mortgages insured by the Federal Housing Administration. The mortgage insurance premium still applies. The 1.75% upfront charge at closing and the 50 basis points charged each year still leave the borrower's financial position and go into the Mutual Mortgage Insurance Fund. But the commercial lender's margin, the profit a shareholder-owned institution must extract to satisfy investors, does not. The mutual cooperative model for home lending still exists. The National Credit Union Administration publishes a credit union locator that covers every federally insured institution in the country. The Oxford Provident model of member-owned cooperative home financing is available in every state. If there is a regulation this archive has not covered, leave it in the comments. Subscribe so the next one reaches you.